Hey everyone, welcome back to Corporate Decoder, the place where we decode your favorite companies, and today it looks like TREX Acquisition Corp is giving us quite the puzzle to solve with this latest filing. So the big story here is a company that is trying desperately to get back on its feet after some serious struggles. We are diving deep into their September 2025 quarterly report, and let me tell you, there are more red flags than a Formula One race. Alright, let's get straight into it. This filing is a 10Q report, which is like a quick checkup on a company's financial health for a 3-month period. TREX Acquisition Corp is reporting for the quarter ending the 30th of September 2025. Let's start with the company's balance sheet as of the 30th of September 2025. It shows us what they own and what they owe. Now, right off the bat, look at their cash. As of the 30th of September 2025, they had a measly $384 in cash. Compare that to $49,733 just 3 months earlier. That is a massive drop, folks, if you had $50,000. And now you have less than $400. Something is seriously wrong. And then look at their current liabilities. These are the debts due within a year. That total is a whopping $1,586,719. That is a lot of money to owe when you barely have any cash. And as if that weren't enough, check out this number. Their accumulated deficit is over $10 million. That means for their entire existence, they have lost more money than they have made. This is a classic sign of a company in deep financial trouble. Now let's look at how the company performed in terms of making money and spending money during the quarter. They reported $7,923 in mining revenue. Not exactly setting the world on fire, but it is revenue. Total revenues for the quarter were just $9,258, which is definitely not a lot. And last year for the same period, it was zero. So yes, that is an increase, but coming from zero is not exactly a sign of a booming business. They actually lost money on the goods they sold after accounting for the direct costs of making those goods. We are talking about a gross loss of $52,670. This means their core business operations are not even profitable yet. And then they have their operating expenses, things like paying their executives and consultants. Those expenses came in at $552,788 for the quarter. That is way more than the $9,258 in revenue they brought in. So it is no surprise that their loss from operations was a huge $605,458. That means after all the selling and operating costs, they lost over $500,000. And when you add in interest expenses and other costs, their net loss for the 3 months ended the 30th of September 2025 was $654,214. That is a serious amount of red ink. This translates to a net loss of $0.03 per S-share. If you own shares in this company, you are losing money on each share you own based on this quarter's performance. Now let's look at shareholder equity. This basically shows you the owner's stake in the company. This table shows us the company's equity from last year to today. It is a bit of a mess with lots of share issuances for cash debt and services. And look at the ending balance for shareholders' equity. It is a massive deficit of $743,200. This means the owner's stake in the company is negative. It is like owing more on your house than it is worth, but for the entire company. This statement tells us where the company's cash came from and where it went. For the 3 months ended the 30th of September 2025, they used $136,387 in cash just to keep the lights on and run the business. That is money that just vanished from their bank account for normal operations. They also spent $7,712 on investing activities, probably buying equipment or something for the business. The only good news here is that they brought in $94,750 from financing activities. That means they likely borrowed money or sold more stock to stay afloat. Without this, they would have been in even deeper water. The company was originally formed in 2008 to look for mergers, but then pivoted in 2021 to focus on cryptocurrency mining and related tech. They have several subsidiaries now, including ones for mining, data centers, and software. This section talks about how they account for things. One key thing is that they now have to mark Bitcoin to fair value. That means any changes in the price of Bitcoin directly impact their reported profits or losses. This is a really important note. The company itself admits there is substantial doubt about its ability to continue as a going concern. This is a big warning sign that the company might not be able to pay its debts or continue operating in the near future. They are relying on raising more money to survive. This note mentions a refundable electricity deposit of $77,069. That is good. It means they might get some money back. They also received a capital credit allocation of $8127, which is like a small refund from the electric company over time. As of the 30th of June 2025, they held Bitcoin worth $17,502 that they mined. But by the 30th of September, that Bitcoin was gone, used for operational expenses. So they are not really holding onto their mined Bitcoin for long-term investment. They have assets like buildings and machinery. The Orofino facility, which they bought in March 2025, is showing some costs. They have a building, improvements, and mining equipment. Interestingly, the mining equipment they bought at that time was fully depreciated by the 30th of June 2025. That is a 1-year useful life, which tells you how fast that technology becomes outdated. This section talks about potential problems. There is a notice of default filed by the holder of the first mortgage on their Orofino property. This means they are in danger of losing that facility. This is where they list the money they owe to people or companies who are not part of the company. There are a lot of convertible notes, meaning they could turn into stock. These notes often come with special deals like warrants to buy stock at a certain price or extra shares just for signing the deal. It is like paying a premium to get lenders to take a risk on a struggling company. This talks about financial instruments that have value that depends on something else, like the company's stock price. They have derivative liabilities of over $100,000 and they lost money on these during the quarter. This section details a lot of stock issuances. It looks like they have been giving out a lot of restricted stock, often as compensation to executives, advisors, and board members. This is common when a company does not have a lot of cash to pay its people. On the 8th of September 2025, they authorized Series a preferred stock. This is a special type of stock that often has more rights than common stock, like getting paid first if the company liquidates or getting a guaranteed dividend. They issued a few thousand shares of this and it was used to cancel some debt owed to insiders. This part talks about what happened after the reporting period up to the date the report was released. There was a significant disruption at their Orofino, Idaho facility on the 23rd of July 2025. There was a dispute with contractors, some equipment was removed, and there was damage. This caused a temporary shutdown and impairment of their software. They did receive an insurance settlement of $63,434 and resumed full operations in November. Additionally, the foreclosure action on the Orofino facility was really heating up. The lender for the Orofino facility started foreclosure proceedings because the company defaulted on its payments. They have a chance to fix it by February 2026. But it shows how precarious their situation is. Now let's look at management's own words about their financial health and future plans. They acknowledge that their revenues increased to $9,258 this quarter compared to $0 last year. But the big story is the massive increase in their net loss. It ballooned from $311,815 last year to $654,214 this quarter. They blame this on a substantial increase in stock being issued for services. They are talking about a working capital deficit of over $1.5 million. That means they owe more short-term debts than they have liquid assets to pay them. It is not a good look. Management says they expect working capital requirements to increase, and they plan to fund this through stock sales and revenue from acquisitions. They intend to meet liquidity needs through raising debt or equity. Essentially, they are admitting they need more money from outside sources to keep going. This section is a bit of a confession. Management states that their internal controls over financial reporting are not effective. They point to deficiencies in segregation of duties and a lack of qualified accounting personnel. This means there is a higher risk of errors or fraud going undetected. They continue to issue unregistered shares of stock in this period. This is often done to settle debts or pay for services when cash is tight. So what is my take on all of this? TREX Acquisition Corp is in a very difficult position. They have almost no cash, significant debts coming due, and a history of losing money. Their reliance on issuing stock to keep the lights on is a temporary fix, and the fact that they openly admit significant internal control weaknesses and doubts about their ability to continue as a going concern is a huge red flag for investors. The Orofino facility situation is also a major risk, as losing that asset could be devastating. The company is clearly trying to pivot and grow in a new industry, but the financial realities are harsh. They are burning through cash faster than they are generating it, and their ability to secure the necessary funding in the future is highly uncertain. What do you think about TREX Acquisition Corp's future? Are they on thin ice? Or can they pull off a comeback? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe to Corporate Decoder for more breakdowns of these financial filings. And definitely check out our Discord community linked in the description where we discuss these things further. Thanks for watching, and I'll see you in the next one.